Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Hi everyone, my name is Michelle and welcome to Through the Noise. The divergence in policies between major central banks in the West, such as the Fed and the ECB, versus the large central banks in the East, such as the BOJ and the PBOC, continues to be one of the most important macro themes. The increasing interest rate differentials continue to pressurize the JPY and the CNY. So how should you be positioning your investments? With me here today, we have Daniel Lam, Head of Equity Strategy. Daniel, so first of all, how do you see the weakness in CNY and how that might play out in the future?
Thanks, Michelle. The recent weakness in CNY since the beginning of May has been primarily driven by a few factors. So first of all, China economic data has been poor. Secondly, the Fed has been hawkish and they have been increasingly hawkish. That has led to a higher two-year US government bond yields, pushing the two-year interest rate differential higher. And thirdly, of course, is the increasing geopolitical risk, including the recent news about the latest round of AI chip curbs by the US. So as the dollar CNH breached the 7.2 level, Chinese authorities stepped in to moderate the pace of the decline by setting a stronger fix. Now, this could lead to near-term consolidation in dollar CNH, but our expectation of further policy stimulus means that the interest rate divergence between the dollar and the CNH is likely to increase in the near term. So we actually do not rule out a test of 7.3 level for the pair. But over a 6 to 12 months horizon, we're expecting the combination of stronger growth in China, in contrast to growth slowdown in the US, to lead to narrowing of interest rate differential. So this may push dollar CNH towards 7.05 to 7.08.
Thanks, Daniel. So how about Japan? There has been noises about the BOJ potentially tweaking their yield curve control policy earlier in the week. But then as the week went past, we have been getting the opposite message. So how do you see dollar yen going forward and what it means for Japanese equities?
Well, like you said, the fact that the BOJ has not been talking about a tweaking of the YCC means that the momentum for dollar Japanese yen could still be on the upside. Okay, and we're looking at a potential level of 150 as the key resistance zone. So a strengthening JPY, okay, should there be any tweak to the YCC or should there be any verbal intervention from the BOJ, is a key risk to the rally in Japanese equities because a stronger yen is likely to impact corporate earnings and put pressure on share prices. But if you are a US dollar denominated investor, the pressure on corporate earnings is actually partially offset by gains from the strengthening JPY versus US dollar. So on top of that, this time around, you have the improving corporate governance, which is a key structural tailwind to Japanese equities. So therefore, we remain overweight Japanese equities and continue to expect a re-rating there. Now, in terms of sector, if the BOJ were to tighten eventually, that is likely to lead to high yields and favor Japanese banks in general because high yields often lead to widening in net interest margin, which means better profitability for the banks. And of course, a stronger than expected economic data in Japan also provides a favorable environment for banks to outperform.
All right, so since you've spoken about equities, how about the prospect for US equities? I understand that the second quarter of the 2023 earnings season is coming up soon.
Yes, so that pretty much begins in the week of the 10th of July with major US banks reporting. So Q2 is expected to be the trough quarter for the year, registering a 5.6% year-on-year drop in earnings, according to Refinitiv's consensus estimates. So earnings growth is expected to revert to positive territory in Q3, plus 1.6%, before accelerating in Q4, nearly 10%. So the expectation for full year 2023 earnings growth remains positive at 1.4%. Now, we believe that it will be very important to monitor any changes to the expected 2023 earnings growth, as well as to the expected 2024 earnings growth, which currently stands at 11.8% plus. So the growth expectations for 2023 and 2024 would reflect guidance from companies. And we have a neutral view on US equities over the next 6 to 12 months, and we're expecting 2023 earnings to remain resilient. So this is very much in line with our view for US recession to start only in the first quarter of next year. Now, let's talk briefly about the sectors. Our preferred US sectors are communication services, technology, and healthcare. So technology earnings are expected to see a pause in 2023 before accelerating in 2024. And in 2024, we're expecting the earnings to be going up by nearly 18%. And tech's largest segment is software, which continues to see a defensive recurring revenue, while AI has sparked significant orders benefiting the semiconductor segment. Thanks.
So finally, the Fed Chairperson Powell's speech this week has been hawkish. This is reigniting investors' debate about, first, staying with short-term fixed deposit because short-term rates are high, and second, looking at the medium term and going for bonds. So what is your take on this?
So, this is a very good question. Short-term cash returns have outperformed long-term bond yields ever since we entered one of the most rapid rate hike cycle in history. But you need to think like this, okay? So cash deposits usually have short investment horizon of 12 months or below. So while the absolute return in the near term is likely to beat bonds due to elevated short-term rates, this comes with reinvestment risk. So i.e. seeking for comparable yields for rollovers after the initial cash deposit matures. So we see reinvestment risk looming as rates often trend lower during a backdrop of peak rate hike and followed by recession. On the flip side, if you're looking at investment into bonds, this reduces reinvestment risk by locking in the yields for further years to come. And also, if you think about it, when benchmark rates edge lower as risk-averse demand surges, long-term bonds enjoy capital gains, so i.e. surge in bond prices in addition to coupon returns. So at this juncture of the economic cycle, we are overweight bonds, especially the higher quality bonds, and expect their outperformance over the next 12 months.
Thanks, Daniel. So this has been a fruitful podcast where we cover a wide range of topics from currencies, equities, and the cash versus fixed income debate. So I hope you enjoy this podcast, and please stay tuned for our future podcast. We wish you a great weekend ahead.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details on the latest market insights, subscribe to Standard Chartered Money Insights.